So just a quick little intro about who OZ FundHub, who we are. We're a neutral marketplace for the entire opportunity zone space. And we have all kinds of great pieces of content or educational content from news to white paper, collateral, etc. But what our core tool is the OZ Fund Finder. And a lot of people relate this as the Expedia of opportunity zones. So what we do is basically take investors, we ask them specific questions about their investment needs and take that criteria and then marry them with the fund that meets, that is the most relevant to their investment criteria. A quick little agenda for today. So we're just going to have the welcome and introduction. From there, we're going to jump into the Pinnacle Partners presentation. And then at the end, we're going to have the questions. So don't be shy to ask any questions throughout the presentation, and then those will be answered at the end of the webinar. A quick little intro about me. I'm Michael Hubert, co-founder of OZ FundHub. My background is within the digital marketing space. So I have 19 years of demand generation marketing experience. About 4 years ago, I founded the Hubert Group Marketing Agency, and some of our notable clients are HubSpot and Forge Global, which are both public companies. And I've been doing demand generation within the opportunity zone space for about 3.5 years now. I myself am also an opportunity zone investor, so very familiar with the space. Now let's jump into Pinnacle Partners. So first off, I'd like to introduce Leo. Leo is the managing partner of Pinnacle Partners. And Leo, why don't you tell us a little bit about your OZ background with Pinnacle Partners and also about how you and Jill came to meet and how she joined Pinnacle Partners as well.
That'd be great, Mike. And thanks for having us. And we like to be on the first webinar panel for you guys. So pleased to be here. If you could maybe shoot to the next slide, that'll kind of use that as my overview of Pinnacle real quick. And so again, Leo Backer, managing partner of Pinnacle Partners, and we formed Pinnacle approximately 3.5 years ago, just before the Opportunity Zone regs were fully out in late 2018. And we are basically a joint venture equity partner for developers with projects in opportunity zones. And we consider ourselves early movers in opportunity zones. We funded 9 projects, as you'll see below here. Now I think we're almost 170 million of equity deployed over 9 projects. And my background is 35 years in corporate real estate, first 20 years representing developers on ground up development in the Puget Sound marketplace. And then the 20 years after that, representing corporate users on leasing and acquisitions of real estate. And my partner, Jeff Feinstein, and I came together to form Pinnacle when we saw these tax regs coming out. We saw this as a place for us to look at, first off, investing ourselves, because we invest in every one of our projects. But we saw a real need for developers with projects in opportunity zones looking for private individuals to invest in these projects in these OZs. And, here we are 3.5 years later and found a lot of success. And, early days, it was blocking and tackling, one investor at a time. And now we've got a very good, list of over 200 investors that have invested in our projects. Jill Holman, who we're really pleased to have us join us as a partner in our fund, has been doing what we're doing on the East Coast. So Jill and I met over 2 years ago as she was working, in DC, working on the OZ regs as they were coming out, but also doing developments. And real pleased to have Jill join us because she's not only been in development, but she's also represented a lot of investors in looking at these individual funds to invest in. So we've been comparing notes for a couple of years and now combined forces to really launch our fund. So with that, I think I'll go real quickly. Again, Pinnacle Partners, we're a real estate investment company focused exclusively in opportunity zones. Jeff and I, you see here, are the managing partners of the firm. We've got the first thing we did, in the next page, Mike, if you would, is we brought on a CFO, Sandy Heffernan, who worked for a very large real estate company in Seattle, managing dozens of assets, hundreds of investors, because as you can imagine, these opportunity zones are very complicated. It was new legislation, And building a real stout back office was first and foremost, what we did before we even had one project under our belt. And Sandy's been influential in helping us get where we are today, not only with our tax and legal partners, but with our Juniper Square software, which is a very robust investor portal to help us manage these assets. And as I mentioned, Jill here joined us about a year ago as we launched our fund at year end for Pinnacle. Next slide, Jake, if you would, or Mike, sorry. So our projects to date have been on the West Coast. We started small in Seattle with our first project, and with our sponsor in Seattle, we ended up investing in a project in Los Angeles and then in another one in Seattle. But the 9 projects to date have all been single assets up and down the West Coast. And several of our investors asked us to look at a multi-asset fund approach. And that's, again, where we came together with Jill to really strategize, what markets would make sense for us to focus in, because we were heavily invested in the greater Seattle area, Northern and Southern California. So what we did is we looked at, really nationwide, what are the high growth markets that we want to be in, number one, and what product type would make the most sense. And multifamily has been the core of our investments to date. We've done workforce housing, student housing, market rate housing, one senior housing project. And we felt, market rate housing, maybe workforce housing in the portfolio exclusively would be the right product type. And we want it to be what we'll call a boutique size fund. We didn't want to be a 10 projects, $1 billion fund like some of our competitors. We wanted to keep it bite size. We didn't want to be a blind pool fund. We wanted to have projects identified prior to bringing this out to the marketplace. And we're pleased to say today we do have 2 projects that we've actually closed on and one under control that we're looking to close on this month. That would be the 3 of the 4 projects identified in the fund. It's very focused on the markets we want to be in. We're looking at, basically, first off, when we go into the marketplaces, we're looking for expert developers in each of those submarkets. That's everything to us, right? So Jill and I use our network from East Coast to West Coast and finding who are the best sponsored developers in each of those markets building multifamily projects. Very important, not only for their expertise, but in today's world with rising costs, interest rates, et cetera, having a developer that has very good general contractor relationships and lender relationships is very important. So we're focused on best-in-class sponsors in each of these markets. And then with Jill's help and our analysts, we really dig into these projects one by one. As you can imagine, it's very challenging, especially in this environment, to find projects that make sense. So we're looking at dozens and dozens of projects each week to filter down to projects that we'll spend time on reviewing. The fundamentals we look for are close to urban core. They have to be in a submarket that really isn't just another project. So we're looking at projects that are off market. We're looking at projects that are close to light rail, maybe have an attribute, as Jill will mention. 2 of our projects are close to stadium districts that are kind of up and coming, which is really what these opportunity zone markets typically are. So really focused on, specific submarkets in these cities that are high growth, have employment growth, wage growth, close to major universities that are also growing, and have very good fundamentals, and also really positive business communities and business governments that are very positive on business growth. We're sitting here on the West Coast, which it can be challenging at times in Washington and California, and we're looking at markets really that we can get through not only a permit process quickly, but where companies are moving. We're following that employment growth and quality of life moves that people are really looking at today, especially in post-COVID times. Next slide, Mike, if you would. So that's kind of the genesis of the fund. Again, with our combined experience, Jill and my experience on focusing on project pursuits and underwriting, Jill's going to go through quickly, our diligence process, and then we'll go through quickly our 3 projects that we've identified, and we want to leave plenty of time for question and answer. But we didn't want this to be a large presentation. Our hope is that if you're on the Zoom and you want to talk to us and reach out to us specifically about who Pinnacle is and about our project specifically, that's our goal. Just to let you know our experience level specifically about the projects and where we're going for here. So Jill,
Great.
with that, I will let you take over.
So with each project, we go through our due diligence process. And so just first to talk about the 4 areas that we think we bring a key advantage are the regulatory expertise, deal flow, investment acumen, and operational expertise. As we had talked about, we're long tenures in the commercial real estate and multifamily investment arena. And also we've sourced what are to date 3 off-market opportunities in really exciting markets and also submarkets. And as Leo mentioned, as the regulations were coming out, we were heavily focused on really being first movers and understanding the impact of the regulations, and also we're closely monitoring what is a potential extender for opportunity zones, which was a bill introduced by Senator Tim Scott that would extend the opportunity zone tax incentive by 2 years. So it's a bill, and it's something that we're closely monitoring and speaking with folks in his office and also other government relations people. As it relates to due diligence with every project, we go through our due diligence process, and I've articulated there 10 steps, and it really starts off with initial underwriting to see whether it merits proceeding further. Then we get into environmental geotech review, so really taking what our developers do and their third-party reports and bringing in our environmental experts in reviewing the reports that were done in a peer review. We go through the construction process and budget analysis. We have our legal review, and then our insurance review. And then we update our financial analysis. Then we go through and look at the developer's background, OZ compliance, real estate tax assessment, and our final underwriting, a go, no-go decision. So that's how we proceed with our investments to date. And so let's get into the deals that we're doing. So if we can move to the next slide. And as Leo mentioned, we really are selecting these markets. So we've selected Denver, Nashville, and Atlanta. Those are the deals that the markets that we have deals in so far. And these are really high growth markets. These are markets that the population has high educational attainment. They have high wage growth and high population growth relative to the national average. And as a result, even in spite of that, you have I would say, call it a modest cost of living relative to the wages that are in place. So meaning it's when you think about the population that can afford what we're building, it's a greater percent of the population as compared to other very expensive markets. And within these particular markets, we're looking at opportunity zones that are high growth opportunity zones as well in good locations. And so the one in Denver, as in Nashville, are both in what's considered stadium districts. So these are districts that are being revitalized and redeveloped around, centered around the NFL professional football stadium. Interestingly enough, the Denver Broncos actually just sold, and I think had a record sale price too. This, excuse me, this project is approximately 200 units of multifamily with on-site parking. It sits along one of the major parks that runs through downtown Denver. And it's also less than 2 miles to about 150,000 jobs. It's less than a mile to 3 major universities with about 40,000 students. It's proximate to regional transit, and with that major path, it's also a bike path that a lot of folks used to commute to downtown and also to the universities. Excuse me. Our development partner is also a general contractor. It's Mortensen Development. So they're a national general contractor and development partner with over decades of experience and millions of square feet in development and having under construction. The project's about a $66 million project, and we are estimated to start construction towards this fall with delivery just at the end of 2023. And this is also a project that we think we're standing to benefit from. We're really excited about our land basis and also about our untrended return on costs, about a 5.8 for this project. So this project was really a lot of the costs and the project was moved forward. I would say probably about a year ago, they really started moving this project forward and are coming out the other end with the site development permit pretty soon, and we'll be able to start construction here pretty soon. So that's
Jill, maybe I just want to add real quickly. Having your development partner as a GC can be challenging at times, but in this marketplace with rising costs and having transparency to real-time costs, we think was critical in our review of this project, because we have been working on this for 6 months. We'll have pricing in place prior to closing on land. So unlike, you can't do that with every project, and having a GC that really has, real-time knowledge on cost, I think is a real benefit for this project.
great. So let's take a look at our next project, which is the one in Nashville. So this project is about 373 units, 350 parking spaces. It also is in the Stadium District, so right near the Nashville professional NFL team on the Tennessee Titans. The location, this is right in the midst of all sorts of company relocations. So Oracle it has a brand new campus that's bringing tens of thousands of jobs there, in addition to other major companies as well. And so with this location, we're actually looking into the CBD. So we have views of the CBD and the waterfront. So it's great location with both access to what is being built, this entertainment district, access to these major corporate hubs, the new, the whole Stadium District, and then with these great waterfront views. We're expecting the construction to commence towards the end of the year, and with a construction completion at the end of 2024. And as you all, I'm sure, have been reading about, Nashville's been the beneficiary, in addition, as I mentioned, to Oracle. We have Amazon, but there's been just a number of companies that have relocated, and the corporate growth is so strong that the multifamily vacancy is about 3% actually, and there's been significant multifamily rent growth because of just the lack of supply, because of so much demand because of all the people moving into Nashville. Our development partner is Stillwater Capital. So they're a Dallas-based, a Texas-based multifamily development company with experience in Nashville. So we're excited to work with them. And this project's about a $120 million project, and it's in the lower fives in terms of an untrended return on cost. And so I don't know, Leo, if you have anything to add for this project, but that's an overview of the Nashville development.
Yeah, I think one note I would like to add is similar to Denver. When we look at these submarkets, Nashville, as Jill has said, and most of you I'm sure know, has been on fire. There's been a lot of development occurring. There is some concern of the market getting overbuilt, even though there's thousands of new jobs coming. So we really like this submarket. It's called the East Bank neighborhood, right across the river from downtown Nashville, where most of the building has happened downtown. So this submarket, with our land basis and product type, we think can be a real premium type unit, but lower costs of being downtown. And in a neighborhood where we'll be, one of 2 or 3 projects that are getting built in this phase. with a lot of growth around us. So we don't like to go into markets that we're the last project in, because then your risk is, with supply and demand. So we really like kind of our position in this market.
Great. So next slide. So this project is our office to residential conversion. It's a project in Atlanta. So there's approximately 286 units. So this is an existing gutted office building. So the floors, as you'll see right there in the bottom picture, have already been cleared and demolished. And so this construction can start pretty quickly this fall. With a delivery also, since we have the base building that's already built, so an estimated delivery towards the end of 2023. This project is right in the heart of downtown Atlanta. It sits directly opposite Hart Park, which is undergoing also redevelopment. So it'll be a gorgeous park to serve the residents and also the businesses of downtown Atlanta. It's less than a half a mile to major ingress and egress, so with I-75 and I-85. And then you have multiple transit options with MARTA, and that will give you access to all, Midtown, Buckhead, all parts of Atlanta. And this were directly, I would call it on campus, quote unquote. Georgia State University has a major downtown campus. And so this is on, considered right approximate to Georgia State University. So we think this will be a beneficiary for, visiting professors and all of the sort of folks that are affiliated with the university, given its location. And then the Metropolitan has added about 80,000 net new units since 2010. So there's just been a strong growth of multifamily within Atlanta. But coupled with that has also been a strong rent growth as well, given the population growth of this market. So what we like about this market is it's serving the what is the downtown business growth, in addition to the university growth with Georgia State University, and then it's proximate to all the ingress and egress to other parts of Atlanta. Our partner on that is Gateway Ventures. So they're an Atlanta-based developer. I've done business with them before, and they have over 40 years of experience in the project in development. And this is about $100 million project, and its return on cost is in the low, untrended is in the low 5%. And so we have an opportunity that we are exploring for historic tax credits, which would be very, very accretive to the deal. But this is if we don't get the historic tax credits, this would our projected returns. Any other thoughts, Leo, on this?
Yeah, I think one thing I would like to mention, we have just completed a project very similar to this in downtown Tacoma, Washington. And it was an adaptive reuse office building to residential, more of a historic building in nature. So it actually had a lot more demo required and a lot more historical features that we had to keep in place. This one has already been gutted. It was actually going to be an opportunity zone investment for a new office building, adaptive reuse, and the office market slowed down. So that's why they're looking at selling it to our development partners off market as well. But the reason that the Tacoma building, we selected it, number one, and why it's being very successful, because we're already in lease up, is the unique type of structure it is. It's proven in that market. And I think the same here, tenants have a lot of choices to lease apartments, nice newer buildings that are pretty cookie cutter. But this building has high ceilings, as you'll see, high, ceiling to floor glass. It'll have the amenities like a new building, but it'll have a unique structure. So it's kind of proving in our market here that I think we'll take to Atlanta that should happen there as well.
So I think, and then as we think about the pipeline, I would revert to the previous markets that we're focused in on. We're looking at a number of projects in in the Southeast, including in Texas as well, that would make up the fourth, potentially the fifth project, but really targeting the fourth project as well. And then looking to finalize our project in Atlanta. So within short order, we've launched the fund. We've been receiving very strong interest from investors. We've secured these and closed on 2 investments. We're finishing our 3rd investment and have a robust pipeline that we're exploring and excited about the potential for investors to move forward with us.
So Mike, maybe before we get to some questions, real quick, I just want to make sure we didn't miss this point, that our role, at Pinnacle, again, is the joint venture equity partner in these projects. So we're bringing all of the equity that the developer needs to build these projects, that 90 to 95% of equity. And with that, we require major decision rights and an active participation in the development. So Jill, with her development background, and myself, but we also hire an owner rep on our behalf that's going to be in these markets, are going to oversee construction for our fund on our behalf. So we'll play a very active role in these projects throughout the whole development cycle and beyond, because these are, as you know, 10+ year holds. So we're very active in that. We also take on all the opportunity zone compliance. So with our tax and legal, we make sure that we're in compliance going in with the project plan, and of course throughout the entire development. So that is Pinnacle's role as well. So Mike, I guess we'll leave it to you for Q&A.
Yeah, guys, I'll take over from here. Leo and Jill, thank you guys very much for walking us through the presentation there. We have a few questions from some of the folks in attendance right now. We'll go through those, and then if you guys have any other items you'd like to add on, please feel free to share. First one here in the chat. Any intention to put any non-real estate ventures into your existing offering or any future offerings?
Not in the fund. The fund is 100%, multifamily focused, ground up development or adaptive reuse. Non-real estate ventures in the future for Pinnacle and, with Jill, potential. We've looked at that. It's kind of frankly how I got into the business initially, was looking at businesses that may want to locate in opportunity zones. But right now we're focused on the real assets.
Awesome, thanks. Another one that we've received from several investors, as you guys know, a lot of investors also look at broader macroeconomics when going through their diligence process and making decisions. Any reflections from you guys on how you're managing risk in an inflationary environment with rising costs? And obviously everyone knows the equity markets are bleeding right now a little bit. Any thoughts right there just on general risk management?
Well, I'll start, and then Leo, if you want to chime in. Sure. But I think, as it relates to inflationary markets, I think multifamily and tangible real assets are a good hedge against inflation, and particularly with multifamily, having the ability to mark rents up annually is one of the benefits of our annual leases. In addition, with the opportunity zone tax incentive, it's a 10-year hold. And so what we're investing in are markets we think are durable markets, so markets that we think have the ability to withstand a slowdown. So that if you think about a downturn in the market, we think these markets and these assets, we have the ability to look through a downturn. These are 10-year holds, so we're not trying to make just an IRR after a 3-year hold. We're looking to really the value creation happens both on the buy in terms of when we venture at what we think are compelling economics. It happens through the operations, so operating the property with excellence and also with experienced team. And then we also think, it's a longer term hold and exiting at the appropriate time. And so we think, exiting after a 10-year hold will enable us to weather what is, the volatility of the daily equities markets or the volatility of what might be a slowdown in the economy. The other point, what I would make is that what we think about in our underwriting is we're thinking about a couple things. Number one is we're thinking about where the market's moving, and so when we think about underwriting interest rates, we're underwriting interest rates going up. When we think about underwriting cap rates, we're underwriting cap rates increasing 5 to 10 basis points a year at least. And then, we're also, when we think about our rent growth, we're not factoring in significant rent growth. So we're really underwriting, about 3% rent growth, 3% rent growth. And we're also underwriting expenses increasing at the same rate as our rents. And so what we're really trying to do is, on the construction side as well, is to include contingencies and include where costs are. And so when we put it all together, what we hope it will demonstrate, excuse me, is taking into account what are the inflation as it relates to the costs, but we think not padding the operating side of it, not really increasing the rents to try to paint a rosy picture on the other side, but saying, we think there's a reversion to the mean for the rents, and we're kind of just, keeping it at 3% growth over there. And so we think our returns, we think that we're showing are really fair. We're not trying to really paint, what is considered the best foot forward for the investors. We're really trying to paint what we think is, a fair observation of the market, and including where costs are, and but at the same time, not trying to significantly, not trying to have significant rent growth on the other side to make up for it. And as a result, a lot of deals will not pursue because those deals, the economics don't, they can't withstand that, and that's okay, because again, keep in mind the thesis of the fund is really a fund sized around finding 4 terrific deals to work on, maybe 5, 3 of which have been identified, and then we'll see, after we execute those investments, we'll see where the market is and see if it warrants another curated fund. But that's really the approach, how we're thinking about the inflation and uncertainty in the equities markets.
The only other thing I'd add quickly, because I know we're probably running on time, is the nice thing about the hold period for these opportunity zone projects. We don't like to over leverage. You don't want to be beholden to a construction loan that gets called at a certain point and you're forced to act. So we try to add as much ability to be flexible with our debt market. So we're very active with our sponsors on placing debt, how much equity we put into these deals. And as Jill said, we're very careful on the underwriting up front. And if a sponsor is going to be aggressive on rent growth and exit caps and low interest rates, that tells us something of how they see the world, and it's probably not a partner for us. So we really like transparency and conservative underwriting is where we try to be.
That's great feedback, guys. Thank you. And also just, for audience's helpfulness or clarity, if anyone wants to, take a look at any specific assumptions or models, you can contact the Pinnacle team directly, and we'll be circulating contact information as soon as this is over. But Jill and Leo, thanks for your thoughts there. And I'm glad you mentioned your current fund. One quick clarifying question. All the assets in your existing fund are multifamily, correct?
Not 100%. We have one adaptive reuse creative office building. And then we have one building that includes an office building, but we're building 400 units of multifamily adjacent to it. But the balance are multifamily, either student housing, senior housing, market rate housing, and we do have one workforce affordable housing at about 70% of AMI using mass timber. So we're really, looking hard at, which really is the true kind of poster child for OZs, right? Is this affordable housing and workforce housing, which we really like. So
I just to be clear, this fund that we're speaking about and that we're fundraising for is 100% multifamily.
Correct.
Atlanta, Nashville, Denver, 3 identified deals. We'll have 1 more multifamily deal or 2 more multifamily deals. Only multifamily. What Leo was speaking about previously were the previous executed deals that Pinnacle did. But again, that's separate and apart from this fund that we're speaking about right now, which is 100% multifamily.
Awesome. Yeah, thank you
That's
for that.
correct.
Thanks for that clarification, Jill. And Leo, good to have some of the historical perspective. With respect to time, we'll wrap it up here. One other important question, though, that I would like just to hear from you guys a little bit more about is relevant timelines now forward facing with respect to your current offering. What should the audience know about any relevant dates here in the near future?
Yeah, so our next, what I'll call close on equity, is going to be the end of this month. And that's really a push for folks with gains realized in last year in 2021, which will be coming up to their 180-day timeline. So if you do have gains that you can look back to last year on, it need to be placed by end of June. That's kind of our next push. Our close after that will be in September. So we're kind of on a quarterly close. We're about halfway through our raise to our $100 million target. So we've got some momentum, but those are kind of the 2 kind of key dates, I would say, is by June 30 and then in September are the 2 timelines. But we'll be, likely kind of bringing in equity throughout the year, as these projects get, finalized and identified. But those are the 2 kind of imminent dates.
Okay, great. Thanks for that, Leo. Okay, well, I think this is a good spot to wrap things up. We've been going for about 45 minutes now, and I know everyone's got things to do. Like I said, we will circulate this to everyone in attendance. If you do have any questions, part of that post-event circulation will include contact information. You can also see it on the screen right now. If you have any questions, we will direct you to the team, many of whom are with us today. But that'll be it. Thank you, everyone, for your time. Thank you, Pinnacle. We've really enjoyed working with you guys and are excited about your projects. Congrats on all of your success so far. And thank you again, everyone, today for your time and attention. Thanks.
Thanks, everybody.